Hello, I'm Bernard Hickey from interest.co.nz and welcome to 90 at 9, brought to you in association with the Bank of New Zealand. This is your morning briefing where you get everything you need to know in 90 seconds at 9 o'clock, starting now with news of more turmoil on European financial markets overnight. Irish bonds and Spanish bonds fell in price, which means their yield went up again on concerns of further contagion from the Irish crisis. A clearinghouse in London has again tightened its margins for trading in Irish bonds. This essentially says it's concerned about the potential for a default at some stage. Meanwhile, the European Central Bank's Axel Weber says he can increase the fund, the European bailout fund, which the likes of Portugal and Spain would have to use if they meet similar problems to those seen in Ireland. Currently, the fund is €750 billion. Meanwhile, in Spain, foreclosures or mortgagee sales on houses may triple in 2011, according to an analyst there, pointing out that new mark-to-market provisions for banks means they're going to have to take losses and therefore push properties onto the market. And finally, the European Fund's bailout head has said it would be, quote, inconceivable for the euro to fail. That meant the euro was down more than 3.5 cents this week. However, the New Zealand dollar has been falling as well, and it's just above 76 US cents. That's after Standard & Poor's warning about our credit rating. And because global markets have been volatile and our currency tends to fall when you see people more nervous about financial markets. That means that our currency hasn't actually fallen much against the euro, and the TWI, the trade-weighted index, is relatively low compared to a week or two ago. I'm Bernard Hickey. That was 90 at 9, brought to you in association with the Bank of New Zealand.